Welcome back to RWA Week podcast and online panels episodes. I'm Pauli Speaks, your host for today and strategic advisor here. And today we have a brilliant guest who I think is going to genuinely change the way you think about real world assets. And not only that, Felipe here, he spent over 12 years in the trenches of European distressed debt markets, which is very niche. So I will learn a lot during this session. I hope that you guys too, analyzing value and underwriting secured and unsecured debt portfolios across something like 15 different jurisdictions. Felipe, please correct me if I'm wrong, which is honestly an insane amount of experience to have in a room. He's now one of the key people behind LynxCap and its DeFi platform called LynxCap.io. So you can go to the website and check it out, which is doing something I find really exciting, bringing the funding side of real European real estate debt on chain, backed by over 100 million euros in real asset value. And this is not a white paper project anymore. This is not a promise. This is a team that has been doing this work in the real world for 15 years and now building the bridge to crypto. So if you ever wondered what it actually looks like when it's serious institutional grade finance meets blockchain, well, today's conversation is exactly that. Felipe, welcome to the show. Really glad to have you here.
Hi, Paule. Thanks for having me. Really happy to be here. And that was a great presentation. Actually, some difficult words there, but
No,
yeah,
it's fine. It's
happy to
fine.
talk you through.
Our listeners used to difficult words, but I think that today we're going to dive in a very niche market. I was like, for me, I think it's going to be eye-opening conversation. But first of all, I would love to talk to you a little bit about your background, about your personal story as well, so you can introduce yourself. So you have spent over 12 years in analyzing value and underwritten secured and unsecured debt portfolios across multiple European jurisdictions, right? Um, Distressed debt is inherently messy and unpredictable. How do you build such mathematical models that accurately prices in the human and legal friction of a foreclosure or a settlement process, like particularly when the legal frameworks differ so significantly from one jurisdiction to the next? It's a little bit long question, and my questions today are going to
Yeah,
be a little bit long and complicated, but I think that it what makes our conversation more interesting.
it's a tough start. May just quickly to my background. I'm originally from Spain. I studied economics and quantitative finance, and then came to Switzerland to join a fund that does something similar to what we do here at LynxCap. So we spent many years there analyzing debt portfolios, and basically some of the core team, I would say, transitioned at some point to LynxCap, which is where we are now since 2019. Um, and yeah, just to answer to your question, yeah, it is messy. It may sound messy, but it really depends, because within this industry or this asset class, you have many subclasses, many different things to consider. So every jurisdiction is different. As you said, we invested, I think it's about 17, if I'm not mistaken, already different ones. So you need to take the specifics of each country into consideration. Then you have different asset classes. You have secured debt, unsecured debt. You have performing, sub-performing, non-performing debts. You have debts to individuals or to corporations. I mean, there's a bunch of dimensions that make the product different. And there are some common drivers, of course. So one just needs to understand what is it that you have on the table, what's the legal framework, what's the product type, and then just go for it. I mean, I think maybe the most obvious distinction is secured versus unsecured debt. This is where, and I think the messiness you refer is mostly in the unsecured space, because there you tend to have. I mean, this is like one can think of credit card debt or consumer loans or something like this. So it tends to be portfolios of thousands or tens of thousands of positions with low value. And they're usually, when you acquire this, you will see that 95 or 99% of the borrowers, they never pay you a penny back ever. Whereas those who pay tend to pay the full amount, right? But it's a very binary thing. You have thousands of cases, so you can model it on a portfolio level quite well if you have the right benchmark. That's the key. You need benchmark data for that. It's quite a statistical type of analysis. On the other hand, and this is our core focus at LynxCap these days, in the secured space, you may think of mortgages, for example, mortgages which are backed by real estate. There, the analysis becomes much more straightforward, I would say, and more easier to assess on a case level, because ultimately you have a real estate property, uh, which is the underlying asset to the loan, and you can go and value it. This is the key element of our due diligence when we want to acquire something, is we send the real estate experts on the ground, and we send them to check all properties and assess the value. So once you know the value of the property, um, you kind of can imply the value of the loan that is underlying. It's just some kind of function of that. Of course, there are more components to it. I don't want to tell you the whole story now. Maybe we go into it a bit later, more detailed. But it's less messy, if you will, and more straightforward to predict. And this is the space where we are now at LynxCap. So basically, it's secured, non-performing debts.
Ujú, ujú. Ok. Antes de nada, qué maravilloso. No sabía que habías empezado en España. Empecé a
Sí,
emprender
bueno,
en
yo soy español, sí.
Maravilloso. Empecé a emprender español hace varios meses. Conozco varias palabras, pero no
Bueno,
muchas.
hablas
So,
muy bien, hablas muy
continue.
bien.
Let's continue in English. But to be honest, that's exactly the kind of an answer I was hoping for, because you just got through so much confusion in like 2 minutes, or maybe a little bit even less. So the secured versus unsecured distinction is pretty fundamental, I think. And yet I feel like most people outside of this industry have absolutely no idea if it even exists. Like when people hear distressed debt, they just imagine some dark room full of stressed bankers. But you're telling us it's actually like two very different worlds, with very different rules. And the unsecured side, thousands of small consumer loans that where their real cows lives, right? Am I understanding correctly?
Yes, I mean you may have seen over the years also messiness, huge messiness in the secured space in other jurisdictions. But for us at LynxCap, it's important to have clean data and to eliminate the randomness as much as possible. So in the secured space and in the markets we operate, which is mainly Spain at the minute, but also Slovenia and Croatia, for example, there we see we basically get what we need, which is the law is clear, the processes. I mean, everything is predictable in terms of the how long will it take to enforce one of those claims. If I have a mortgage rank 1, then does it mean I am the first who will, let's say, be paid once the asset is liquidated, and so on? This is not obvious in some other jurisdictions, which is why we explored those but didn't really invest, because we
Mhm.
need this certain. I mean, there is some randomness, of course. I mean, otherwise we would just be investing in bonds or something. But there is randomness, but we can quantify it, and the risk or the yields you get versus the risk you take are actually on a level that we like. But yeah, to answer to your question, I mean, in Spain, in the secured space, you have loads of also public databases where you can find information on the properties, you can find information on the mortgages that the bank is claiming to sell you. So you can make sure that actually they do own those mortgages, that they do have the the terms on the mortgage that they are telling you they have. I mean, all of this is verified in the due diligence process. So there's not really randomness in. I mean, the only thing that is random really on a case is the outcome. Kind of will it go through the whole enforcement procedure, or will you find some kind of amicable settlement with the borrower? This is on a case level, right? Each case will go one way, but on a portfolio level, um, we have enough statistics to know that X% will go this way, which takes this time and costs this much, and other percentage of cases will go this other way, which takes shorter time and maybe has a lower cost leakage. So yeah, it is relatively certain. Of course, I mean, we have, as you mentioned at the beginning, I mean, we have many years of experience, and we use this, of course, in our judgment calls. We always try to be conservative in our assessments, which doesn't mean we haven't done bad investments. Of course, sometimes you just make a bad investment, but when you're conservative in this approach and you try to eliminate the randomness as much as possible, on average, on the long run, you'll tend to be to overperform a bit, which is the case in LynxCap.
Mm-hmm, mm-hmm. I hear you, and to be honest, it might sound boring, like to avoid randomness, but or to eliminate randomness. But this is actually the most stable and fundamental ways on doing the work that you're doing right now. And Spain does feel unusually predictable compared to many other property markets, which is interesting. And when the mortgage data, ownership history, due diligence, all are all transparent, it removes this huge amount of maybe even emotional stress from the process. And it's also funny because in some countries buying property feels like a detective work, but here it sounds more like a paperwork and patience. And statistically, when banks already know debt ratios, income exposure, how much households usually spend on loans, the systems become much easier to model and trust, I think. And like you said, the random part is less about hidden surprises and more about which approval procedure or administrative path the deal follows. So that kind of stability may not sound exciting on a podcast, but for investors and normal buyers, boring is actually a very beautiful world and word. I think. But in traditional NPL markets, and let me a little bit dive deeper in that. An NPL market refers to a trading ecosystem where banks and financial institutions sell their non-performing loans to third-party investors. And an NPL is a loan where the borrower has missed scheduled payments for maybe 90 days or more, and these markets transform bad debts into tradable distressed assets. Just for the listeners and for myself to remind too. From a data perspective, how do you translate those qualitative relationship based recovery assumptions into these hard data points that a smart contract or on-chain treasury can actually rely on?
Yeah, maybe just one small comment on what you said a couple of minutes ago. So the buying property is difficult and is expensive, especially in Spain, because when you buy you have it everywhere, but in Spain it's significant, the cost of buying a property, the taxes you have to pay. It's really not efficient to buy and flip properties in Spain, because in most of the regions you pay like a 10% tax just for buying on top of the price. But luckily we don't buy properties, we buy loans which are backed by a property. So it's some kind of derivative or indirect way of getting exposure to the properties, which is highly efficient cost wise. Um, And as mentioned before, I mean, we have and do rely on a lot of quantitative data. We have we do valuations of the properties. We review the land registry to make sure we do have a mortgage and in what terms. We review the legal documentation if there's a legal procedure on each case. Um, we review loan documentation to make sure it is enforceable or there is no, let's say, bad practice performed by the bank at origination. I mean, we basically check everything to make sure on each case, on each claim, we have a good visibility and we do, let's say, individual underwriting on each of the claims. Um, but of course, there's also a bit of qualitative judgment, where it basically comes from our experience. I mean, as you mentioned, right, we have many years looking at different opportunities. And just to give you a fact, we look at, I mean, on average, we buy or we succeed in one deal out of 20 that we analyze. So it means there is hundreds of portfolios that we look at every year, and we acquire just a few because I mean, obviously there is competition in many of the trades, but also we are really firm, let's say, in our underwriting standards, and we like to be on the safe side. And the qualitative aspect comes more, I would say, um, not as hard data points, if you will, in the model, because the model is what it is. It's mostly factual based on information that we know and we cross check. Um, but of course, you see that this portfolio maybe is slightly worse because I don't know, because the liquidity of the properties tends to be a bit lower than average, or because this bank in particular, they don't have very good origination standards, and their clients are maybe, let's say, of a different type, or the different profile than some other bank or whatever. There are thousands of examples I could give you, but then this is something that you can't really translate into a number, but we of course take all of these things into consideration on a deal by deal basis, and this usually how we translate this into the model is just by requiring higher returns from a specific deal if we see the risk is higher. Uh, but still, the data is what it is. So if you have like 500 properties in the portfolio and they cost what they cost, because it's not,
Okay.
but you could say, I mean, if a real estate expert values you 500 properties, then the deviation from market value, I mean, it will be very tiny, right? It's easy, especially in the residential segment, which is where we mostly operate. So yeah, it's more like a judgment call sometimes, when we see something that requires or that is not ideal. We just we would require higher returns from that investment, and that's it, right? If we get it and we get it at higher returns, then we are happy as well to take on that higher risk.
Okay, got it. So that is very important distinction, I think, because people often imagine NPL investing as this purely relationships-driven business with guys shaking hands in back rooms. But what you're describing is much more disciplined and data-heavy than that. And buying property directly in Spain can be expensive. Thank you for mentioning that, and inefficient. Sometimes transaction costs and taxes are close to 10%, which is crazy. So buying loans secured by property can actually be the cleaner and more capital efficient way to get exposure. And before anything happens, you're reviewing land registries, legal enforceability, loan documentation, collateral quality, and all the hard facts that give this visibility on recovery potential. And the qualitative layer is there too, but it sounds less like gut feeling and more like experienced pattern recognition built on thousands of data points, is at least of what I'm hearing. And I love that your point that you only succeed, or maybe like one deal out of 20, because that tells me that the underwriting discipline is real and you're like willing to walk away most of the time, which is good sign. And even something subjective like weaker property liquidity in certain region eventually becomes quantifiable, though many through like maybe through longer recovery timelines or lower expected recovery rates or higher discounts assumptions. So the human judgment still ends up translated into these numbers, the system that can actually play a price, or I am understanding it wrong?
No, I mean, yeah, we try to stay disciplined. I mean, that for sure. In the underwriting, I mean, we've seen many players come and go, and we've been there for 15 years, right? The competition changes. Most of those we see today, we're competing with us. We're not there 10 years ago, and maybe will not be there in 10 years. Um, so yeah, it's very different. Also, some of our competitors, they have a different approach. I mean, what distinguishes us and what makes us really flexible, and what also allows us to afford losing deals, as you said, 19 out of 20, it's basically that we don't have operations in any of the country. We outsource all the management of the portfolio, the servicing. It is outsourced to third parties on the market, to top tier servicing experts. But most of our competitors do have this kind of integrated into their companies. So then you often have this problem that you have a bunch of people that need to work on something, and then you are kind of pushed to make bad investment decisions just because you have 100 people sitting there in a call center and they need to work on something. So for us, this has always been a no-go, and this allows us to be flexible to say, I mean, yes, now we see a strong pipeline in Spain of good deals, but maybe in 1 year it's not the case. So then we can easily just start investing in another market with the same approach. And as a matter of fact, we are constantly in parallel exploring other markets, participating in processes, trying to learn, just to be ready also, and to enter another market, because you never know. It's very cyclical. I mean, a few years ago, if we had this conversation, Spain wouldn't even be one of our markets. We were very focused on Eastern Europe. So this has changed, but who knows? In 5 years, we may be talking about, Italy, or France, or Germany, or some country, even in some other continent. These are also things we are exploring, not only Europe. So you never know. You just need to. I mean, when you come to the place when already everybody knows that it's a good place to be, then you are late, right? So we
Yeah.
are always trying to be there, proactive, and try to find new opportunities.
Yeah, exactly. I agree here with you, but it also depends on like I think the geopolitical situation. It depends like which countries will be still left with us, yeah, to be able to make any kind of a projections further. But 15 years in the market already says a lot about the discipline and survival mode. We both know that the industry is full of players who show up during like good years and quietly disappear when things get tough. So what I found interesting is that your idea that the strength comes from being able to lose deals, because in many cases the real flexibility is not pushing harder, but simply walking away when the numbers or structure not right. So yeah, I think that this is strength, and honestly saying for 15 years often matters more than winning any single deal. Though As we were speaking about different countries that we'll explore as well, over your 12 plus years working across multiple European jurisdictions, how has the approach and risk assessment in secured and unsecured debt evolved? So, like maybe there can be some specific quantitative tools or methodologies you believe are still missing from the traditional finance space?
Well, it's really dynamic, and it's really uh, hard to answer with just one answer, because it really depends on the market and on the type of product. Um, we see that, I mean, the behavior of the borrowers changes over time, because they learn how to trick you, to trick the system. So this is something that it's just natural. So the let's say the behavior of the individuals changes, the laws change, the tax environment changes. I mean, everything has an impact, right? So you really need to be um, on top of these changes and adjust the models if needed. If the law changes, I mean, I can give you an example. If the for example, back in the day, we were buying unsecured portfolios in Czech Republic, and those borrowers were all in bankruptcy, and then suddenly the bankruptcy law changes, and now it completely changes the recoverability of the portfolio. So all your benchmarks you can you don't need anymore, right? And then you need to completely reassess the logic. Or in Spain, for example, before 2019, um, the enforcement law was it had some flaws. It made the process really long and unpredictable to some extent. Since 2019, this was changed, and now you have more, you know, clarity on how the process works. So these things you just need to adapt. You need to be on it, um, because it really it's very dynamic. You can't use your model from last year or from 5 years ago to price a portfolio today. If I mean, maybe yes, but you need to be aware of the changes.
Then there is a constant checks with the updates on regulatory landscape and constant conversation in WhatsApp or email with your legal counsels need to be in
Yeah,
place.
which we have. Yeah, which we have, because I mean, we have partners where, as mentioned, right, we have our partners um, who manage the portfolios, the day-to-day activity, right? Of course, we supervise everything, but the day-to-day workout is done on the ground. Those by people who are, what they do is that, right? So it's their only field of expertise is managing such cases, so they know exactly if there's any change affecting any of the metrics that drive the process. So in that sense, we are always up to date on the markets where we have active investments, at least.
And when you mentioned Czech Republic bankruptcy law change, that's exactly the kind of shock that can quietly reset all your assumptions overnight. And I have seen similar patterns when even like 5 to 10% shift in recovery rules can completely change the portfolio economics, especially in unsecured debt. And maybe from quantitative side, finance still kind of struggles a bit with real legal and behavioral elasticity, if I can call it like that, meaning how people react when incentives or enforcement rules change. So when like we have strong tools for probabilities and defaults, but we're still missing maybe better dynamic models that combine like load changes, borrower adoption, and recovery timing in one system. So that would be good improvement, to be honest. I think that's what missing. So in a way, your point lands pretty well. The real edge is not just modeling risk per se, but staying close enough to reality to update the model before reality updates you. If yeah, like
Yeah,
this.
I mean, let's say if I think I I know where you're going to. I mean, this is it's clear that finance or economics or any economic model, I mean, it's not really science, even though some people, I mean, me as an economist should maybe say this is science, but it's clearly not. I mean, it depends on the behavior of thousands and millions of individuals, which is unpredictable. Um, but I mean, when this is why we don't buy single exposures. For example, there's also a market for buying um, one or two or three large corporate tickets, for example. But they're the risk is too high because you don't know. I mean, it depends on one going this way or that way, and then your whole investment is either good or bad. But when you buy 1,000 mortgages, then you know that on aggregate, you know where it will go. If you ask me this case in particular, how will it resolve? I don't know. I can guess based on the parameters what's the most likely outcome, but I may be wrong. But on a group of thousands of those, which is what we acquire, um, you tend to be right, especially as I mentioned, if you take a cautious approach, you will tend to be slightly above what you expected, and this is a bit how we deal with this. So, I mean, this is especially in the secured space. As I mentioned, I mean, it's really not rocket science. The models are fairly simple and deterministic. You just need to do the work, and you need to understand. Um, but if you do the proper work and you check everything you need to check, um, you don't put any crazy assumption just because that allows you to have a higher price so that it's more likely that you win. That's not our approach. So if you stay reasonable, as I said, the model is simple. You need to do the work, and then, as mentioned that quite at the beginning, I mean, you have a real estate that is behind each of the cases, and that real estate, you know what it's worth, and then the outcome will not differ very much from the value of that real estate in the end.
Mm-hmm. Okay, okay. Very grounded way to look at. Thank you, Felipe. And honestly, it's closer to how credit actually behaves in the real world. It stops being like one borrower will pay or not pay, but it turns to into what do thousands of people do on the average when incentives and income and stress change. So that's also why diversification matters so much. I think with large enough pool, the randomness starts to smooth out a little bit into something statistically more stable. But I want to dive deeper into LynxCap.io, into platform and mechanics, because I saw several questions from our audience, and Paul is helping us to answer them. Thank you, Paul. Hi, Paul. Maybe we can dive deeper. So LynxCap IO offers a stable yield backed by real world investments targeting a 50% plus on IRR. And given the material shifts in interest rates and real estate valuations across Europe over the past, let's say, year, how have you adapted your internal underwriting and stress testing models to ensure that yield remains sustainable and secure for DeFi stakers?
Yeah, maybe just a quick intro now that we shift to LynxCap.io. I mean, let's say the way how we traditionally financed our investments was through issuing bonds on the Luxembourg Stock Exchange, which is still our main source of funding. Um, LynxCap.io just kind of replicates that same logic. So we offer um, investors, smaller investors, because bonds are for professional investors. So this is for any individual, really, with no cap on the amount and no lower bound. It can be anything. We offer them just to participate in the same economics as our bondholders. We offer 10% at the minute on LynxCap.io, which is the same as we have as our bonds offer. Um, and how we manage to, or how they can feel safe, it's simple. I mean, our target returns are way above that. So, and history has shown that we always, or not always on each investment, of course, but on average, tend to be higher than our underwriting expectations. Um, so that's how they can feel safe. Moreover, I mean, at the minute we have, I think real estate backing our investments is around 100 something million of euros, and outstanding debt is around 30 million. So this is mainly it's bonds in circulation. I mean, LynxCap.io is still a little baby. We hope to grow it, but now there is not much there yet. But yeah, but that's a bit the idea. I mean, we offer the yield to our investors that is that makes us feel comfortable that our investments target much higher returns. And I mean, yeah, we've done like that since the very beginning, really. And we were always able to satisfy our debt compromises. So we don't expect this to change. Yeah.
That's actually very clear philosophy, and I like how simple you keep it at a core. Like if you translate what if I can translate it a little bit, so you don't chase per se yield itself, but you survive by pricing conservatively and rejecting more deals, like 1 out of 20 makes though. And in a world where rates and European real estate valuations have moved a lot in the last year, that discipline becomes more important. I just wanted to like jump back into our conversation. So effectively building a buffer with a structure where 100 million in real estate sits behind like roughly 30 million of outstanding debt, which is a pretty strong over collateralization story on paper. And instead of constantly tweaking assumptions, your edge seems to come from being consistently conservative. So the average outcome drifts slightly about expectations over time, and I think that that's a very different mindset from aggressive optimization in most of the DeFi projects, like when like you have 50% yield on top throughout the year, 30%. But it's more
Yeah.
like price for safety and let time do the smoothing. And I think that in credit markets, that boring discipline is often what actually keeps yield stable enough to feel sustainable for investors.
Yeah, no, absolutely. I mean, we offer 10% because I mean, we would offer a 6 if people would get it for the perceived risk, right? But 10 is what at the moment 10 is what works, where there is interest from investors, and we just price accordingly the portfolios. If tomorrow we can issue bonds at 5%, or we lower the yield on the DeFi on LynxCap.io to 5 or 6, and people are happy to take it, then we can be more aggressive on the portfolios we bid for, right? But there always needs to be a cushion um, between the cost of funding and the yield we target on the investments. So for sure, if we grow and for example, if the LynxCap.io gets a lot of traction and we eventually can reduce the yield, then we would be more competitive, and maybe we succeed in 1 out of 15 deals we participate in. But always keeping the same philosophy. I mean, in the end, let's say the target return that we aim for is a function of the cost of funding in the end. So if we get cheaper funding, we can bid a bit higher price on the investments. But what we will not do is, you know, um, get funding at 10 and then bid for a return of 12 or 13. That makes no sense, right? So there is always enough cushion, and this is what I mean. This over the years is what generates equity in our company, and is what now brings you to this snapshot of 100 million real estate versus 30 million of debt. I mean, this is years of just being disciplined. So yeah, this will never change. I mean, this is just the core philosophy we have.
Wonderful, wonderful. Love that. But when also bringing real estate, secure data on chain, I think that data integrity is crucial. And how does actually LynxCap IO ensure that the off chain performance data of these portfolios spanning multiple European jurisdictions is accurately and securely reflected on chain for investors?
Well, on chain, I mean, to be completely honest, I mean, not much goes on chain. I mean, on chain at the minute is, let's say, a funding instrument that we use. Of course, we want to be transparent with the investors, both bond investors or DeFi investors, and we will always show the key metrics of our company. I mean, we are audited, of course, we are an audited company, so everything also is available, all yearly reports. But when when it comes to data integrity, and this is really one of the things we can be really proud of, I think, at LynxCap, is our LISA, it's so-called LISA infrastructure, which is stands for LynxCap Investment Software and Applications. So it's an in-house developed IT environment, database, reporting platforms, and so on, which is really tailor-made for taking on any type of investment, really, in any jurisdiction. Our partners are where they commit to, or we ask them to do certain reporting into our systems. And everybody does that, and it's in a standardized way. It can be a Slovenian partner, or it can be a Spanish partner, or it can be an Italian or a Indonesian partner. They will report certain things because they have to, and it all flows into our database, and we have reports built on it, and we can be proud that we have like really good data. To give you an example, I mean, we know everything on on each claim that we have under management, each asset. I mean, we know when is the next auction, what's the legal status, what was the last milestone in the legal process, what's the current outstanding balance, what are the payments that have been, I mean, you name it, we know everything. Because that's important. I mean, for us, data integrity is important, and we learned from the past in that. I mean, I can give you another example. We worked at another fund before that originally was investing into unsecured portfolios in one particular jurisdiction, and then the whole IT infrastructure was built around that very specific asset class. And then over the years, we started to invest in other jurisdictions, and we started to invest in secured portfolios. And then there was nowhere to track the not even the collaterals we had, the assets. This is something that I think all of us learned from, and here at LynxCap from the get-go, it was just paramount for us to kind of develop this in-house in a way that it's kind of scalable and comprehensive, really, and it works for any. I mean, I can't think of any type of portfolio that we could possibly buy that we couldn't have enough information on, or get the reporting done on it. So it's really flexible. But all of that is off chain. Let's say on chain. As mentioned, I mean, it's a funding instrument, so there's public information on our website, of course, on annual reports and everything, so anyone can go see it. and when you look at the numbers, you understand that the yield that we that we offer, it is sustainable. And one thing I forgot to mention before, when we say a 10% yield, and because I mentioned before that maybe we change it or something, I mean, the yield we offer is for anyone who makes an allocation and stakes USDC on the platform. That yield is guaranteed for him for the lockup period, no matter what. We can't. We would never change the yield of money that is already committed. It's only for new deposits in the future. That I should not use the word deposit. My lawyer will not be happy. But yeah, we understand
Yeah.
allocations into the platform. Um, because that's our commitment. And you were mentioning before those yields you see in DeFi of 30 or 50 or something. I mean, we've all been there. We all got burned because that's what happens when you go there. I mean, and I think LynxCap IO is a consequence also of that. I mean, we or some of us have been in the crypto space on private level for many years, and got in touch with all these crazy projects, and we all did our extrapolation of how much money we would all have if we stay in that for 3 months. But the reality is, you in 1 week it's already all your money is gone,
Liquidated.
right?
Got liquidated.
Yes, so LynxCap IO is a bit also an answer to that, or it's to come to the DeFi space and say, look, we have something. I know it's not exciting that you have to be locked up for 2 years. We understand that there are, I mean, if we discuss later future or next developments that we have in mind, we have a solution to that, and we are working on it. But as of now, it's a 2-year lockup. Because we're just being honest with people. I mean, we're telling you, look, first, you can go to our website, see all our faces. I mean, we're real people. This is a real office. We've been many years doing investments. We are just a TradFi company. And this is what we can offer. We can't offer you 30% because our yields are not that high. We can't allow you not to lock it up because our investments are not liquid. Our investments have a weighted average life of like 3-4 years. So we can't offer you money that is not locked up. We have it now at 2 years just because, as mentioned, it's just 0% compared to our all other funding instruments which are outstanding, which have a 3-4 year tenor. But yeah, I mean, that's the reality, right? We can offer you 10%, and this is what we do. It's maybe not as exciting as those other things, but if you put your money here and you come back next month, it will be here, and it will pay you 10%. And when you come 3 months later, or 3 years, or 10 years, it will still be the same. And this is a bit our, well, at least the idea we had here, to offer something that is a bit antagonic to all those other projects where you don't even know exactly who is behind and how are they making yield.
No, it's pretty clear, and it's stable and predictable on your side, which is very secure, and people can sleep safely and calmly for 2 years, and then come and see the yield that is there, that is guaranteed. I know that it's not the word that we can say, but anyways, it is. So just
And
wanted
not
to.
only, not only, I mean, they don't need to wait 2 years. The yield is claimable. To give you an example, the whole team is also invested in the platform, just to, we think it's reasonable to put skin in the game on one hand, and on the other, because we actually like the product. I mean, we designed it kind of, so we like it. And the yield you can claim any minute if you want to, or any day, or any, and and actually you can directly benefit from it. For example, this is a true story. That I paid my lunch today with my yield. So you have a, I don't know if you're aware, but there are like some software wallets like MetaMask, for example. They now have this debit card that you can just use to literally pay for for stuff you buy in the store with your yield from the LynxCap.io, for example. I mean, it's not like you wait 2 years and see what happens. It's actually you benefit from it from the very first day. So no,
Yeah,
we
that's a very good distinction. Thank you for mentioning that. It's I think it's very convenient for most of the investors, and especially if you can buy a supple for yourself just from a yield from LynxCap. Pretty realistic and practical too. So I just wanted to give some comments on your answer in terms of bringing real estate secured debt on chain, right? Um, Everyone imagines that everything on chain means everything on chain, but in reality, it's DeFi discipline. And LynxCap is actually saying, like, you don't put the real estate secured debt itself on chain, but the funding investment. And so you can rely on the internal system called Lisa, which I didn't know about it, which is pretty interesting. And I think a very smart way to do it, to keep everything connected. And that's where it gets interesting, because you aggregate data from local partners who are basically doing the day-to-day work across different European jurisdictions, and you're talking very detailed, like case level tracking here, payments, balances, legal statuses, basically like the health dashboard of every borrower and collateral. And also leaning heavily on audits and structural reporting is relevant here to highlight, because it matters a lot when studies show cross-border portfolios data can have up around 10 to 15% inconsistency if systems are weak. So there is even a bit of like, we learned the hard way notes. I can hear it, but since earlier setups in the industry apparently broke down when portfolios became more complex across jurisdictions, so it's a good decision to have your own software, and Lisa is a good name. Yeah, but yeah, overall sounds like the system built of necessity first, and then refined into something that tries to make complex credit exposure feel pretty clean and trackable, and you can buy SAPA from the yield. It's wonderful. Maybe the last question that I will have for you for today, Philippe, as we're a little bit out of our time on air, I just wanted to know the future plans and of LynxCap, as LynxCap IO, the DeFi platform, continues to grow its European real estate debt portfolio, maybe not only European soon. What are the next else on your roadmap? Are there any specific new asset classes, deal structure, geography, writing for the future integration to the platform?
um, yeah, maybe the answer is twofold. So from LynxCap side, let's say the just the TradFi side of things, I mean, we continue exploring other options. We are now that we speak, we are analyzing different opportunities in Spain, on other markets as well. So if we have this discussion in a few years, we may be active now in, elsewhere. So this is always a thing that we keep in parallel with the ongoing underwriting processes. And from LynxCap.io, a lot of exciting things to come, I would say, because we are just at the very beginning. We now, I mean, as mentioned, right, we now offer a very basic product, which is you deposit. I should stop using deposit. You stake USDC. You get a yield of 10% that is guaranteed for 2 years. But these 2 years are a lockup period, so you can't take out the principal until you reach the lockup. But you can take out the interest as it comes. Our future plans there, and we are working already on making a whole, let's say, what we call like the LynxCap DeFi ecosystem. I mean, we want to add different pieces to this. One of them, the key, and I already mentioned before, is a liquidity token. It will be LLT, Lynx Liquidity Token. This one, basically, the logic is, well, to overcome this problem. We know it's a problem in the DeFi space to have a lockup. So what this token will allow you to do is to early exit your lockup period. You will receive LLTs, tokens for your principal, on a 1-to-1 ratio, and you can either go to sell them on the secondary market, or you can redeem them for USDC, again on a 1-to-1 ratio on our platform, with a certain cooldown period, but a short cooldown period. Then we have a bunch of use cases in mind for the LLT token, to basically generate liquidity for it and to make its value be as close to par as possible. So one of them will be that you can use it to make a new deposit at a 1-to-1 ratio. So people who want to enter a new deposit would then just step into the shoes of those who exited. And another one will be staking of LLT without any lockup period. So there's a bunch of things there around the LLT token, which we think will add a lot of benefit to the users. There's also an airdrop envisaged of this LLT token once it is live. And people can already collect points for this airdrop as of now by staking into our platform. There is another idea also to issue another token which would be more like equity-like to some extent. So no guaranteed yield or no fixed yield, but a bit having some upside based on the performance of a certain investment. So this is, but this is more a longer shot, but it's something we are also working on defining the economics of this and see how it would work. So yeah, those are some of the ideas. One of the things also we have already in place, and which we think is quite beneficial for the users, is a referral system whereby any user can share a referral code with his friends or community, and get directly a 3% of the allocations that those friends or family would make. So it's a way, we see it's a strong incentive to people to talk about this. I mean, if you like the product, you can also benefit from so basically each investor becomes like a little broker to some extent. If he likes the product, he can go and share his code with his friends and then directly benefit from it at no cost to his friends. It's LynxCap covers this 3%. There's no detriment to the new user, rather the opposite. By doing so, by using a referral code, once you register, you even get a boost to your airdrop points. So it's basically a win-win. So it's a way we defined to create an incentive for everyone to really try to grow this, and we think it's very powerful. So we hope it gets a lot of traction in the coming weeks.
Wonderful. Yeah, well, I will be that one referral for sure. That I can promise. And what I'm hearing here, that it's built a bit of a split story between LynxCap as an investment engine and LynxCap.io as an early stage platform layer. And on LynxCap side, you're gone pretty wide, around 15 jurisdictions, you said even 17, which is honestly a lot in real estate that, and across secured, unsecured, performing, or even non-performing assets. And right now the focus seems to be Spain, and especially real estate secured portfolios, but with a very clear mindset that no single market is permanent. Plus, LynxCap.io, it feels more like product roadmap phase. Where things like LLT token are meant to solve these classic pain points, like lockups and liquidity friction, and you're also trying to engineer utility into it, which is good, like using it for staking. I will not say deposits. So it behaves almost like what you're jokingly called like a Presidio stablecoin. Even
Yeah, it kind of in my mind at least it would be a stable coin because it's a token that is it's redeemable for one USDC, 1-to-1 on our platform with a certain cool down period. So it will always be very close, but probably just above uh, full parity with USDC. But yeah, in practice, it's like a little. I don't know if I should be talking about this because again, I mean, I think issuing a stable coin in US dollars is yeah, somebody may chase me after this, but so it's not intended to be like this, but you could see the the synergies with the stablecoin.
Yeah, I can see that too. And yeah, look, it's wonderful. And there's also second layer idea with more equity like token, which is basically introduces like a high risk, high return profile for people who want more upside, as far as I understood it. So overall, sounds like one side is disciplined and like credit allocations across Europe, and the other side is trying to slowly turn that into more flexible, tokenized investment ecosystem, which is brilliant. I love it. I love it. I will dive deeper into the DeFi platform by myself after our interview. And yeah, because I'm a Web3 native child, I entered the space 6 years ago when I was still a teenager and never left. So yeah, this is pretty exciting. And on that note, I would say that is the end of our today's podcast. I would love to extend a huge thank you, Felipe, to you.
Thank
Gracias.
you.
It was a wonderful conversation, and I genuinely didn't want to end this because every story just opened another layer on how deep and thoughtful this work really is. And what I'm taking away from today is that real world asset investing done right is not just about hype, it's about discipline, right? Winning one deal out of 20, building your own data infrastructure from scratch, being honest about lookup periods, and using blockchain where it actually helps rather than everywhere, just because you can. And LynxCap is still very early on its journey, but the foundation, 15 years of institutional experience, 100 million in euros in real estate collateral, and the team that has seen every mistake in the book is about as solid as it gets in this space. And so, Felipe, if you want to share some final thoughts for our listeners, feel free to do it. Thank you again. And dear listeners and viewers, please drop a follow to Twitter of Felipe, to LinkedIn account, connect with LynxCap team. And yeah, I would love to have more conversations like this together.
Yeah, likewise. Thank you very much for the time and for giving us voice in this space. Yeah, I mean, final thoughts. No, we, as mentioned, right? We think this is we try to be really open. We offer what we can. We are sure this is sustainable. That's why we offer it. Otherwise, we would not. And yeah, we invite people really to go, to go have a look themselves at LynxCap.io. They can find us also on social media. We are happy to, to speak to anyone if anyone has a question on this. No problem. Just reach out to us. And thank you so much.
Awesome. Thank you, Felipe. Fue un placer. Nos vemos pronto.
Igualmente. Que vaya bien. Buen día.
Awesome. And thank you everyone for viewing, watching, leaving comments. I see that today we have a lot of different questions. And thank you, Paul, for helping us here to answer every question that is there. So, yeah, thank you so much. And see you soon next week.